Good morning, everyone. Welcome to this discussion forum on fraud, irregularities and corruption presented by Kreston, South Africa. I think in this day and age, you will agree with me that it's a very topical and a very current discussion and topic that we can address. Because of the COVID-19 restrictions, we couldn't get all the panelists in one location and in one room. Therefore, we have recorded this webinar. We are in compliance with all the COVID regulations, but the panelists are viewing this webinar with you now currently. And we will try to answer your questions throughout the webinar. So please post your questions and hopefully we can address all of them throughout the webinar. If there's any questions that we can't address immediately, we will come back to you either in an email or in a way that we can address those questions. I quickly want to introduce the panelists and the presenters to you. I am Jacques de Villiers. I'm the CEO of Kreston South Africa and the Managing Director of Kreston Johannesburg. I will be hosting this, and then our first presenter will be Jacques van Wyk. He is from JJL. And they are forensic specialists and also part of Kreston, South Africa. Welcome, Jacques. Then we've got Phillip Kaliati. He's a senior manager in Kreston, Pretoria on the consulting division, and he will give us some more insights on data analytics and how data analytics can be useful when combating corruption and fraud. And then lastly, but you know him quite well by now, is Johan Heydenrych. He's a tax specialist in the Kreston, South Africa, in the Kreston Pretoria office. And you know him by now as an excellent presenter. So Johan, we are eager to hear what you're going to say, how tax is affected by fraud and corruption and how we have to deal with that. So on to you as audience, welcome. I trust we've got the correct audience or participants here today for this webinar. Please note, this is not a webinar that will teach you how to commit fraud and corruption. Then you're at the wrong webinar. This webinar is to give some insights on your responsibility when fraud is encountered and how you can prevent fraud and corruption in your business. Now, we as professionals never want to encounter fraud and corruption, but unfortunately, it is something that exists. It is something that you are going to encounter, and we will look at a few topics, and we hope to answer a few questions in this discussion forum. We will look at the Prevention and Combating of Corruption Activities Act of 2004. We will look at what are the income tax and VAT consequences of a contravention of the Prevention and Combating of Corruption Activities Act. We will look at what are your recourses in law when fraud is committed by an employee, and is there any difference in approach when fraud is committed by a senior director as opposed to fraud committed by non-management. We will look at what are the income tax, PAYE and VAT consequences if an employer abandons efforts to recover stolen monies from an employee. We will also look at data analytics and how that can assist directors, internal auditors, and external auditors and due diligence specialists in the identifying of fraud and irregularities. We'll also touch base on how you have to disclose it, the disclosure requirements under IFRS, PFMA, MFMA, and if you come across corruption and irregularities. We will look at what the responsibilities of the people are, for instance, external tax practitioners, internal financial managers who are chartered accountants, and external auditors and reviewers as well. So we'll look at a few topics and hopefully that will give you some insight in fraud and irregularities. So let's go on to the topics. And firstly, Jacques van Wyk, hopefully you can give us some insights, you as a specialist in forensics and what you have come across with your decades of experience assisting clients in dealing with fraud, corruption and theft. Can you please describe what you consider to be a fraudulent, corrupt or irregular act in the context of a business? And what are the activities that are addressed by the Prevention and Combating of Corrupt Activities Act in 2004?
Jacques, thank you very much for the opportunity. So just, fraudulent obviously is a misrepresentation that potentially or actually lead to loss. And then corruption is obviously abuse of office, where you, by your action, manipulate and allow for benefit. And then the last is obviously irregular. And so in that case is where we act, but it might not be unlawful, but could lead later to unlawfulness. So there's a lot of words being thrown around, and there's a lot of definitions, depending if you're looking from, accounting perspective or a legal perspective. But in the end of the day is where you have actions that lead to loss or even potential loss to a third party, be it between you and the state or being between you and another entity. It could also be that you as an individual or your organization, where you use your organization as a vehicle, then as your accomplice in inverted commas here, because legal entities, obviously, although they have legal standing, it is the directors that act, and therefore it comes down to the person that comes down to it. So you make reference, obviously, to PRECA. Under Chapter 12, it defines corruption as any person who gives or accepts or offers to give or accept any gratification amounting to an unauthorized or improper inducement to act or not to act in a particular manner or is guilty of an offense. So there it's very broad, and it says basically by your actions and your intentions on that. So, one should be very careful, even if you insinuate that you are willing to do certain things, if somebody else does something, or that you're willing to give them some illegal benefit or gratification. So one should be very careful in a position as director or as a manager in terms of it. Now, if we look what is confined under the common law offenses, so the private sector, we look at theft. That's where we take away somebody's property or the access to that property. Fraud, we spoke about the actual or intentional misrepresentation that causes prejudice or potential prejudice. Extortion, where we threaten people to do something or not do something, and we are advantaged by this. Forgery, where we compile documents in a false manner to get a benefit. And then last one is uttery, where we use forged documents. Now, important, if you look at PRECA, it only kicks in amounts above 100,000 or more. So if I steal your laptop, PRECA would not be applicable because the value is beneath 100,000. So in broad terms, Jacques, that is what we look at if you look at PRECA in the private sector and some of the definitions and actions which falls then under that portion of legislation to the private sector.
Okay, Jacques, what other acts or laws are designed to stamp out fraud, corruption and irregularities?
There's various legislation that obviously forms part of this. So we have obviously now PRECA that we've just discussed. We have the Prevention of Organized Crime, which of 1998. We have the Protected Disclosure Act 2000, which assists whistleblowers, which we know in South Africa, unfortunately, is a unprotected species. You have to read the newspapers to appreciate how people are being persecuted for being honest. We have the Financial Intelligence Center Act of 2001, where we have to declare certain transactions if we have certain suspicions and above a certain amount. Then we have the Protection of the Constitutional Democracy Against Terrorism and Related Activities Act of 2004. And the last one is the Competition Act of 1998. These are not the only legislation, but these are the main pillars. And then we have other supporting legislation that speaks to these, but these are the main functionary legislation that we would use in investigations. So in terms of supporting would be, for instance, your Companies Act, which brings down certain duties and responsibilities to directors and members and how companies act, for example. So nothing stands in isolation, Jacques. It is all interrelated, if it makes sense to the listeners and the viewers out there.
Okay. What are your recourses in law when fraud is committed by an employee? And does it make any difference in approach when fraud is committed by a senior director as opposed to fraud committed by non-management?
You know, so if we look at positions, Jacques, obviously in recourse, basically we can look at recovery. So if our organization has suffered a loss, you would bring a civil suit against your employee for the losses suffered, which would be application to court, attachments of assets or pension, for example. But you have to prove your loss in court in order to reclaim. Then obviously you will have to also bring like criminal charges. There's a duty on you to report any unlawful activity. Should you fail, then you and your entity might attract liability as being part and parcel as if you've committed or plan to commit that crime. So therefore, so civil on the one portion, criminal on the other portion, and in the criminal matter, you will then have to support the police and, for instance, maybe the Hawks in order to investigate, give them documentation statements, and support them in order for them to do the investigation, and you might need to testify. So you end up being on both legs, civil and criminal. So now you asked a question about, you know, in terms of a director or a senior manager versus a normal employee. You would hold your directors and your senior employees to a higher standard because they are on those positions because of knowledge, ability, and therefore they ought to know or have access to sources and information that would give them a clear indication of what is right and wrong. They would have access to the external auditors. They would have access to their legal teams. They would have access to internal audit. They would have access to experts like us that can assist. So therefore, when court comes to sentencing, they would look at Jacques, let's say as director, and say, Jacques, you held a position of trust. You were supposed to give guidance. You knew that this was wrong, and yet you didn't act. Therefore, my sentence might be quite more severe than a receptionist that steals money from the petty cash or abuse a company credit card versus Jacques that gets involved in creating of fictitious assets or overstatement that leads to loss to shareholders or the public. So yes, your position can impact on when we come down to sentencing because of your knowledge and being held at a higher standard, Jacques.
Okay. So let's look at disclosure requirements. Hopefully you can assist me here. Under IFRS, PFMA and FMMA, with regards to fraud, irregularities and corruption, what are the disclosure requirements?
All right, Jacques, thank you. Good question. So obviously the PMFA and the MFMA relates to the public sector, and in its most basic form, it basically says any employee that becomes aware or suspect the occurrence of irregular expenditure or fraud or corruption must in writing report it to the accounting officer or the accounting authority, i.e. to the highest level. If you look at the PMFA and the MFMA, obviously they are supported by various schedules and treasury notes that are issued by National Treasury that clarifies those roles. Now, if we look to the private sector, obviously, if we look at IFRS and ISA, over the years, there's been a much bigger push that there should be greater transparency in the reporting. And therefore, and it's obviously the standardization of financial statements. Why? To make it more comparable. I think over the years, we've seen that where financial statements are very consolidated or contains very little information, those are typically entities that later on we find there are huge problems. So for this, you know, IFRS and ISA also links up for corporate governance to me, you know, so it places, you know, greater responsibility and clarity. We have King 1, 2, 3, and 4. I mean, where we have corporate governance and was born out of the King 1 to 4, and that's evolving. So now if you look at IFRS, and once again, there are various IFRS and ISA that we can refer to, but for just today, because we have limited time, you know, IFRS 7 places a disclosure compliance that must be adhered to, and that the auditors, external auditors, must take note of. Then we also have ISA 240, where the auditor, you as external auditors, must give great consideration in terms of what approach will follow, to ensure that there are no material misstatements in the financial statements that could hide, for instance, fraud, and obviously how you will direct your teams and who you will select in your teams to do that. So we have both legislation, we have an audit approach, we have legislation, and then we have corporate governance, and all of those come together. So it's not just about, Jacques, about ticking the boxes. It now also pulls through to our corporate culture. So if we take that, then we say that there is a lot of tools and cogs in this wheel that turn together to ensure that we arrive at the right outcome. But it comes down to culture as well. If we encourage our staff, our managers to report things that concern them, that worry them, instead of just having, there is severe consequences if you do not. So it comes down to culture as well, which says we encourage, we support, we listen. And I know I've taken a lot of components, but bring them together. But we tend to look at, we write another piece of legislation, we bring out another standard, we make the baseball bat bigger. But it's all about our organizational culture and our leadership as well, Jacques. Encourage people to speak up. And when they do speak up, do not punish, because that will deter people. Then you can have 1 million rules and nobody will report. And then you have failed in what you wanted to achieve.
Okay, so the directors almost determine the culture of the company and what they implement and how they implement it and how they encourage people, etc. So let's say I'm a director of a company, and we look at personal liability. I'm the director of the company, but I fail to implement any procedures to reduce the risk of fraud, corruption, and irregularities in the company. And then those actions, are committed without my knowledge. Can I be held personally liable?
Absolutely. You other than having the title and obviously getting the big salary paycheck at the end of the day, Jacques, it's your responsibility to ensure that certain things are in place. You can't just stand back and say, well, I have managers and senior managers. You as a director must show that you as the board of directors have on an ongoing basis assessed the risk to your organization and that you have taken appropriate action to manage those risks. Risk being exposure to fraud, corruption, collusion, and all those big words on that. So you cannot stand back and just say, well, I did not know. Well, the law says, Jacques, you are a very knowledgeable person, and therefore, at minimum, I advise our viewers today to make sure that they have at least the following in place to a greater extent limit the risk that they face as directors. First, ensure that you have a risk management program in place, and preferably it should be in a written format, where it conveys the expectations, and management to the organization as a whole, as what is your approach to managing fraud risk and any other risks as well. Today is about fraud and corruption, but there's many other risks that your organization faces. And obviously ensure that on a yearly basis or 6-month basis, you revisit those policies. You revisit the programs that you have in place, Jacques, to ensure that they are still relevant to protect your organization. So it's not a once-off exercise. You should sit every year with your external auditors, your internal auditors, your risk professionals, and sit and say, can we review? Do we need to update? Technology is a great driver of change, and with technology, there are new risks that your organization might face. So it's not a once-off investment. It's an ongoing process that you have. Then obviously put those programs in place and monitor them to ensure that your organization is safe. Then also ensure that we have the necessary systems in place to detect those irregularities. And Phillip will obviously speak to us a bit later. Data analytics is one of the tools you have in your toolbox in order to uncover or potentially raise early red flags, okay, that you can then attend to and preferably prevent, those events of happening or your organization suffer huge losses. And lastly, you should have a reporting channel in place, Jacques. So be it a fraud hotline, be it an anonymous tip-off email service where your staff members can report irregularities or issues or concerns that they might have. So Jacques, you can't wash your hands and stand back and say, I'm a director. No, the responsibility comes back to you as the leader in your organization, is that you must ensure that the necessary things are in place, policies, procedures, and systems that will minimize those risks. Otherwise, you are negligent in the carrying out of your duties. So it's tough being a director, it's tough being a senior manager, but if you take the paycheck, you take the responsibility.
Okay, great. Thanks a lot, Jacques. I think let's bring in, you mentioned data analytics. Phillip Kaliati, he's a specialist on data analytics, and he uses that quite often to assist companies. Phillip, how can data analytics assist the directors, internal auditors, external auditors, and due diligence specialists to identify fraud and irregularities?
Thanks, Jacques. Before we go into the detail of what's possible with data analytics, I think it's helpful to just have a quick discussion as to what that is. And the reason I think that's important is because data analytics can mean a lot of things to different people. So, for example, say the CIO's perspective of it might be slightly different to the internal auditor's perspective of it, which might be different to, like an analyst working in marketing or at a, say, large software company and that kind of thing. So generally speaking, I'd say that if you're looking at tools that help you visualize data, that help you automate actions in interrogating your data, and tools that allow you to aggregate data from different sources, mixed in with a bit of machine learning and artificial intelligence, then I would deem that to be data analytics. If you zoom out, there is a lot more to it than just these 4 points that I've discussed. For example, like if you're looking at it from an architectural point of view, then the CIO's biggest concern might be cloud computing and like engineering the IT environments to accommodate data analytics. But from our point of view, for the purpose of this discussion, we're more looking at things from the perspective of the auditor, internal, external, a forensic investigator, etc., and of course, like the directors, of a company. So, so there's a continuum to analytics. I think today's iterations of Excel very much fall in that category, but it's not a tool that's really designed, like with the audit use case in mind. And like from Excel, you get audit power tools, which I think would be most relevant to our discussion today. And at the extreme end, I'd say, like pure data science as a discipline would probably be the most advanced and sophisticated of this. So I think one thing that a lot of lay people find intimidating about data analytics is that the discussion tends to be driven by, by the hyper specialized end of that continuum. But I think for the purpose of, like basic fraud detection and that kind of thing, it is very much an accessible concept and accessible idea that should be deployed, with to a greater extent than we do see in practice. And there are different types of data analytics. You get, like descriptive analytics on the one hand, and prescriptive analytics on the other hand, or I should say on the other end, with diagnostic and predictive in between. So really, that's kind of like an indicator of maturity as well of your analytics environment. For audit purposes, prescriptive analytics may not always be necessary. This would be like where your analytics environment actually has decision-making power as well, right? So a classic example of this might be For example, applying for a loan and having, like the system reject or approve a loan based on attributes applicable to you and based on, based on all of these models that they might have run in the background. Or it could include, like, say, things like evaluating employee applications, job applications, and shortlisting. From a forensic point of view, I think the descriptive and predictive analytics are probably most relevant, and in my mind, the easiest to deploy as well. If we move on to the next slide, so where's the biggest benefit of analytics? The biggest benefit, I'd say, is it does allow for the auditor to be proactive, right? So generally speaking, the pattern you tend to follow, well, to say in practice, is you have an incident of fraud, and then there's loss experienced, and it's only after that that you can actually address it. Whereas if you have a reasonably, capable analytics tool set in place, then it is you should be able to address some of these risks proactively. And the other advantage of analytics, and thinking back to the continuum that I mentioned earlier on, with Excel on the one end and pure data science on the other. So I'm really looking at the middle, where we're looking at audit power tools. So there, the volumes of data that you can deal with are far greater, than you might manage with a spreadsheet. So in our environment, we use Caseware IDEA, which we distribute as well. And just to give you a sense of, like the difference in capability between something like Excel and Caseware IDEA, for example, is with Excel you have a row limit of 1 million rows, whereas with IDEA you have a row limit or record limit of like 2 billion roughly records per worksheet / database. So you're looking at very vastly different capacities, of processing power. Without a tool such as IDEA, then you might have to resort to using things like pure SQL, which is not really our area of expertise as accountants and auditors, but something like a well-designed audit power tool should help you bridge that capability gap. And with the right tool set, you should be able to read information from different sources, and you should be able to handle non-financial information as well. So from a forensic / fraud detection point of view, this might include things like, say, joining your records for your access points for the building and comparing that against asset movement information from like RFID chips that are embedded in your assets or your assets barcodes. So if you do have an incident, then you would be able to marry those two data sets together and single out where the most suspicious movements happened and maybe identify a perpetrator in the event, like say there was a theft. So that's an action you can't really do with something like Excel. And I think the most interesting use case for audit power tools / analytics would be the opportunities for automation that they give you. So it is possible to set up continuous monitoring such that the system, continuously looks at your databases and your systems and is on the continuous lookout for suspicious events that you define beforehand. And if anything happens, then you're notified immediately, which is quite a different approach to what has been done traditionally, which is to schedule your audits on a periodic basis, and then act on findings that you arrive upon, like say 6 months after the event. And that can be the utility of that information, of that kind of information, does diminish over time. A classic example would be, for example, things like duplicate payments. So you don't want to catch a duplicate payment 6 months after the fact, right? You want to catch it as it happens. So a situation like that would be very appropriate for continuous monitoring, and that's one place where the right analytics tools would help you. And of course, in a more sophisticated environment, then an audit power tool would help you, the auditor, work with your data science people in, for example, creating training data for the machine learning models. So that's a use case that wouldn't be common it wouldn't be a common use case for most companies, but if you do have a capability in-house, then that's quite, yeah, it's definitely something that you would make use of as well. So in terms of how difficult analytics is to implement, and this will be on the next slide. Like I mentioned earlier on, from an accountant/auditor's point of view, and by extension, you know, like from the director's point of view, with regards to fraud, I do believe that the most relevant avenue to implementing analytics would be through using an audit power tool. And if you're using the right tool, then there shouldn't be any need for specialist expertise in those different elements that I mentioned earlier on. So, you know, like data aggregation, you shouldn't need to know. You shouldn't need to learn SQL, you know, to interrogate your data. You should be able to do that through a user-friendly interface. You shouldn't need to know how to build machine learning models from scratch. The features within the software should have that powering, you know, the audit functionality in the background, etc. And at the most basic level, there shouldn't be any need for wholesale change in organizational practices. So one thing that worries a lot of CIOs, for example, would be, you know, like if we're implementing analytics, you know, like what needs to change? Do we need to buy X new servers or rent a substantial server space on Azure or whatever the case is? Do we need to go out and, you know, like carry out integrations between all of our systems and so on and so forth? From an auditor's point of view, all of this should be possible, you know, by just implementing a product that's off the shelf, and you should be able to get going pretty much immediately. And to that end, I will demonstrate how easy it is to implement continuous monitoring, you know, just to sort of move away from buzzwords and to show you what is achievable in practice. So I am going to switch over to my screen. I'm going to present this side. So what we have here is an example of an audit power tool. In this case, it's Caseware IDEA. So I'm going to demonstrate setting up continuous monitoring for detecting suspicious payments. So I have a database or some sample database imported into the application already, which includes sample payments. So let's imagine that I'm the auditor and I want to set up this process for monitoring continuous payments. And the way I'm going to identify continuous payments is to see if there are any payments that have been made to suppliers that are not on our approved suppliers list. So step number one is I'm just going to go to macros, start recording. And now I'm going to bring in our suppliers information. So in this case, it's Excel. In practice, you'd be reading this from your system directly, right? So you might be reading from SAP directly or from something like Sage Evolution directly as well. So you can set up an application like this to read straight from your system. So in this case, I'm going to bring in an Excel file just for convenience sake. So there's our suppliers database. And now it's in the system. So what's the next step? The next step is we just need to set up that procedure where we're looking up our payments against the supplier database. So I'm just going to go here, say join. This would be like a VLOOKUP in Excel. Not exactly, but the same kind of principle. So we are looking at payments and we're comparing them against the suppliers. And we're looking for payments where there's no corresponding supplier number. And we're just going to tell the application to look up the supplier number in the one database and the supplier number in the second. And we'll output the results as suspicious. I hope I got the spelling right here. And now the application will carry out that analysis. And these are the results. And as you can see, like these supplier numbers here, just by looking at them, they're very suspicious. It's the same duplicate number repeated, I don't know, 84 times. So, right, I'm going to stop recording this. And I will save it as the different options. I will save it as Visual Script, which is a drag and drop interface for creating procedures like this. So let's save that. And I will call this suspicious payments. Hit save. And then we're done. So we've told the software what to look for, and the next thing is to just schedule it, right? So all I need to do is go to the macro that I recorded, hit schedule, and it seems that I opened up IDEA with the wrong administrative privileges, so my apologies for that. I'm just going to close it and reopen it, but while that's busy, basically what's happening here is the application will run on a scheduled basis and using a schedule that we predefine. So that could be on a once-off basis, and it could also be on a periodic basis. And in this case, since we're doing it on a continuous basis, then it would be periodic. And I will make it, let's make it, say we want this to run every day at a specific time. Then I'm just going to define my schedule here. Let's say we want it to run at, say, 5 o'clock. So 5 o'clock. Let's make it 5 o'clock every day. There we go. Hit OK. And that's pretty much it. You have set up a continuous monitoring process to look for suspicious payments. But as you've seen, it is a very simple process. And I think if you don't have such capability in your environment, it is something worth exploring. And this is just one example of a test that can be carried out. And in practice, if you're carrying out an audit, then you will understand what risks to look out for. And it could be anything under the sun, really. It's the limit is your imagination. So yeah, so I hope that in the discussion we've had, we have helped to demystify analytics and to illustrate how easy it is to implement in practice. If you need more information on how to do this in your environment, you're welcome to reach out to us. We are a Caseware IDEA distributor, and there are other tools out there that might fit in your environment as well, but we are available to assist also. Back to you, Jacques.
Thanks a lot, Philip. Yes, it sounds, or it looks much easier than what I anticipated in the beginning. Thanks for that. And let's look at the tax implications. As you know, everything that you do in life has a tax implication. Johan, is there any specific legislation or guidance from SARS that provides guidance on how a taxpayer must deal with fraud, theft, and corruption? Because I assume this also has a tax implication.
Well, thank you, Jacques. Just as I was listening to Philip, I must say I was thinking just to warn everybody that it's not only auditors and professional firms like ourselves that got data analytical capabilities, but it's also SARS that got data analytical capabilities. And their ability to extract money from you is very much linked to the data analytical capabilities. So if you are trying to commit tax fraud, which is the first category of what I'd like to talk about, then be very careful, because SARS is actually a world-class organization. It's got a world-class Commissioner for Inland Revenue. He has surrounded himself with world-class people, and they've got really world-class electronic systems, e-filing systems, as well as data analytical capabilities. I often wonder whether government shouldn't invest the same kind of effort in the departments responsible for delivery in government as they do in the department responsible for collection of revenues. So let's talk about the two categories of fraud that you can find in a tax environment. The first one is actually simple tax fraud. That is, if you are lying or making falsified statements in your tax returns, or it's for your organization. So the first section I want to talk about is section 180 of the Tax Administration Act. And that section says that a person is personally liable for any outstanding tax debt of the taxpayer to the extent that the person's negligence or fraud, so it's not just limited to fraud, it also expands to negligence. Now, negligence is also something, it's not criminal, but you measure it against what a reasonable person should do. So a reasonable person in a specific position would implement certain procedures in making sure that you comply with the tax laws. So if you're negligent, if you don't act like a reasonable person, so it needn't be malicious intent, then you could be personally liable for the tax debt of that company. And it's not limited to the public officer. It can be the person who controls or is regularly involved in the management of the overall financial affairs of the taxpayer. So it can be a financial manager, it can be a financial accountant, and so be very careful for that section of the Tax Admin Act. The next section actually deals actually with fraud and theft. So section 235 talks about a person who acts with intent to evade, or very importantly, to assist another person to evade tax or to obtain an undue refund. So it's not only the person that gets a benefit that is going to go to jail. It is also the person that assists them to get a benefit. So the tax practitioner, the financial accountant, the director, who knowingly makes a false statement in return can be guilty even if he or she does not personally receive any benefit. And it's so strange. I've done so many courses, and it's when we were used to doing the courses in person, people come to me afterwards and said, you know what, my employer or my client, he says to me, you know, claim that legal fees or claim that capital expense or don't disclose that income, all those kind of things. You are going to jail for a period not exceeding 5 years. So at least you'll be out in 5 years. But be very careful for that, because the law is quite stringent against the committers of tax fraud. Was also the understatement penalty table, and it is such an important one, and I've mentioned that numerous times as we have these talks. It is a separate income flow for SARS. There's been case law about the behaviors that's attributed to this, but look at that. Intentional tax evasion up to 200%. Gross negligence is up to 125%. And those are gross negligence, intentional tax evasion, those are criminal acts. Those are fraudulent activities. So just know that if SARS is going to pick you up, then you will have massive understatement penalties. The way to get out of it is obviously to use the voluntary disclosure process. And under the VDP process, one of the most important benefits is that the SARS will not pursue criminal court cases against you as the individual. I found this statement by SARS, and it talked about just a tax advisor that was manipulating VAT returns, and she stole fraud amount of 1.9 million rand. There were theft charges of about 1.1 million and fraudulent charges of about 1.9 million rand, and she's going to jail for 10 years. Overall, her convictions was for 30 years, but the convictions can be served concurrently, so she's going to go to jail for 10 years. So be very careful. And our Commissioner for Inland Revenue says that SARS is deeply committed to uproot criminality, especially as it relates to tax-related matters. And he's very happy of the fact that the courts are actually supporting them all in this. But tax fraud is not just the big things. It can also be the small things. It's interesting, in this week, SARS hosted a webinar on the home office expenses. And one of the comments that they made was that in the first 400 claims they queried on home office expenses, after they claimed it, 280 taxpayers withdraw their claim for home office. So clearly they were sailing close to the wind. Be very careful when you're looking at tax, and make sure that you're actually complying with the laws. The reality is, in a country like ourselves, you know, you shouldn't be happy if your neighbor is not paying his dues to the taxman, because that means you have to pay more. It's like insurance fraud. If somebody is committing insurance fraud, your premiums go up. That's a reality in our country. If somebody is not paying the taxes, then what happens? You have to pay more because you're trying to be compliant. Okay. So a country like ourselves, we have to make sure that we stamp our tax fraud, and that we support our tax authorities in actually collecting. But by the same token, we also need to be very diligent as residents to make sure that this tax monies are being spent properly and they are not being wasted. So that's the first aspect. The second aspect that I want to talk about is not tax fraud. It is the consequences of fraud, theft, corrupt activities, irregularities, and the like. That's a category 2. So, Jacques, you asked me, what is the guidance of SARS? Now, SARS have issued an interpretation note 80. They revised it in about 2014, so it's a relatively updated interpretation note. That interpretation note only deals with the income tax consequences of stolen monies. It doesn't really deal with corruption. It doesn't really deal with fraud. It doesn't really deal with irregularities from a PFMA, fruitless or wasteful expenditures. So what does deal with that? So the law itself contains section 23(0) of the Income Tax Act. It's a very important section. Let's talk about that one. Deductions not allowed in determination of tax and income. Section 23 tells you that you're not allowed to claim certain things. So it says that you can't claim a deduction for any expenditure incurred where the payment of that expenditure or the agreement or offer to make that payment constitutes an activity contemplated in Chapter 2 of the Prevention and Combating of the Corrupt Activities Act number 2004. So Jacques van Wyk dealt with this law. And if anybody follows Zondo Commission and you hear with shock and horror about the bribery and the tender fraud and all of those things that's been happening, if an entity makes a payment to somebody to smooth the wheels so that you can get a tender, that payment is not deductible for tax purposes in terms of section 23(0), because that payment, let's call it an inducement payment, is a contravention of the Prevention of Combat Corrupt Activities Act. So when you make that payment, even though quite clearly it's in the production of income, if you do not make that payment, probably you're not going to get that tender. So if you make that payment, it's not tax deductible. Okay, so that's the first one. The second one is which constitutes a fine, charge, or penalty imposed as a result of an unlawful activity carried out in the Republic or in any other country if that activity would be unlawful had it been carried out in the Republic. So if you get a fine for the contravention of the Competition Act, you can't get a tax deduction. If you get a fine for speeding, you can't get a tax deduction for that. That's why the reason you can't get fines. And again, if it wasn't for the section, theoretically, a taxi driver can get a fine for speeding, because the quicker he drives, the more people he can transport, the more money he can make, the more tax he will pay. So arguably, it's in the production of income, but clearly that's not the situation. Now, obviously, it can also apply if you are contravening the environmental laws. So a company may say, well, it's cheaper for me to pay an environmental penalty than for me to install all this equipment in my factory. So I'm rather going to pay for that. So if you pay, still you can't get a tax deduction. And the third one is any expenditure incurred which constitutes fruitless and wasteful expenditure if you are subject to the PFMA. Now, obviously, most of the entities that are subject to PFMA are tax exempt, but many are not tax exempt. So if the Auditor General or the auditors make a list because it's a disclosable item, fruitless and wasteful expenditure, all those expenditures need to be added back in the tax computation. So let us go to value-added tax. Now, unfortunately, the Value-Added Tax Act doesn't have an equivalent to Section 23(0). Now, remember, 23(0) says that if you pay a bribe, then you do not get an income tax deduction. Now, the question comes in: if you have paid somebody to smooth the wheels, and that person gave you a tax invoice, clearly he's rendering service for you because he has now gone out and spoken to some people and paid them some money and did a few things with him. Can you claim the VAT? Theoretically, I suppose, in terms of, because there is no equivalent to 23.0, you can claim the VAT because the service was rendered to you and you've used that service in order to ultimately make supplies in terms of that tender that you've won. Theoretically, I suppose you can claim the input VAT. In practice, I think SARS will challenge you. In practice, they will, because the courts tend to frown upon that. And I'll show you a few cases where the courts have frowned upon illegal activity and allow you any tax benefit from that. But it's unfortunate. I believe that the Treasury should look at this and implement a similar section to Section 23.0 in the VAT Act. So be careful whenever you are faced with any fraud, theft, or anything like from a VAT treatment. So I often get involved in due diligence. I often get involved in the tax consequences of fraud, but it takes on many forms. So for example, I've had a situation where employee colludes with a supplier, and it's a supply of stock, and the employee was working in the stock department, and he was authorizing requests for payment, and the stock was never delivered. So they've received a tax invoice, they've claimed the VAT on the tax invoice, but they've colluded. So the question comes in, can they claim the VAT? In that particular case, the stock was never delivered to the client. So because the stock was never delivered to the client, there was never any supply made, and you can't claim the VAT on that. So the first thing is you've got to add back the VAT. So if the person is colluded and it was 10 million rand plus VAT, it's 11.5 million rand. The 1.5 million rand would be lying in your input VAT. You would have claimed it. The 10 million rand would be lying in stock. And in that case, the lawyers went along and they tried to claim 10 million rand from the individual. They should have been claiming 11.5 million rand because that's a total amount. And we immediately paid back the 1.5 million rand under the VDP process because you were never entitled to do that. All right. If a debtor's account is, for example, rolled, and I've also come across that somebody in your debtor's department you receive money for customer A, and you put it into customer B, and because you constantly siphon a little bit of money from the debtors, and you take a little bit of money for yourself. Ultimately, when that debtor is then written off, because even though the debtor has fully paid his account, your records shows that he's only paid 50% of the account. When you write that balance off, clearly you can't claim a VAT on bad debts because he has paid. It's not bad debt. It's a theft. It's a theft of cash. And then when an employee steals stock or anything from you, or if they abuse the telephone system, if you then prove that against the employee and you want to recover that money from the employee, you must pay output VAT on that recovery. So the employee has taken stock, they've taken stationery, they've taken everything. You say, you owe me 10,000 rand, and you recover 5,000 rand from you. Remember to pay the output VAT on that 5,000 rand, because that is then effectively a supply that you've made, and it's a consideration for that supply. It's very critical that in that employee case, you take all steps to try and recover the money. Because if you say, well, okay, I'm just going to let you go, don't worry, just resign and get out of this place, and I'll write off the 10,000 rand. That then becomes a fringe benefit, because you have in law the right to recover that money from the employee. You now choose not to recover it. You waive it. Arguably, it's because it's an employee. In some instances, I've seen these things against directors, and where the director may know a few things that he shouldn't be knowing, so they say, just go, and he goes. That can lead to a fringe benefit on which you have a PAYE liability. I've seen situations where directors, marketing director, have colluded with the supply of marketing goods and over a period of time siphoned off over R1 million from the company. You need to pursue that, because otherwise you've got a fringe benefit. So be very careful for the VAT implications as well as the income tax implication. And this is how I've addressed the employment tax side as well. In an employment situation, it may well lead to an employment tax situation as well. As I've mentioned, interpretation note number 80 was issued by SARS, and it only deals with the income tax treatment of stolen money. And I'm going to take some time and going through this interpretation note. It's a very interesting interpretation. And as you'll see, it quotes case laws that's going back to 1922 to 1961 and 1965. And the case law is not always, it's not always clear. And you can see in certain instances, SARS actually criticizes their own cases. But let's go through this. All right. So it provides you guidance on three things. It talks about the tax deductibility if somebody has stolen money from you or embezzled money from you. The second one is what is the tax situation if you recoup such money, and what is the tax situation in the hands of the thief. Now, as we speak, the country is burning. As we speak, there are looting going on in the country, and it is anarchy in many areas of the country, and it is really, really horrible. But as a taxman, I can't help by saying there to each of those thieves, remember to disclose that fridge and stove and camera and TV in your personal tax return, because it is taxable. Okay, so let's just remember to disclose that because you are a thief, and that's all that you are. So the interpretation actually deals with that. So when any of those looters come to you for tax advice, please tell them to disclose it in their tax returns. Okay, so the first thing it deals with is theft by employees. And it's very interesting. It starts off by looking at a case, which is a relatively old case in the 60s, and it dealt with a firm of chartered accountants. And in the firm of chartered accountants, one of the clerks employed by the firm embezzled clients' money and embezzled money from the employer as well. In that case, it was held that that was deductible in the hands of the chartered accountant. The term that you ask yourself is whether or not the risk of theft in your business is an inevitable concomitant of running this type of business. So if you run a firm of chartered accountants, it is an inevitable concomitant that a clerk will steal money from you. Unfortunately, you would expect better, but it is an inevitable concomitant of the business. So it was held to be tax deductible. The next case is ITC 952, and that is a 1961 case. And in that case, it was a partner in a partnership, in an attorney partnership. So it seems all the professional firms are subject to theft and fraud. The partner actually stole the money. And in that case, the court found that the essential factor to determine is whether the dishonest removal of funds was a reasonable incidental risk to the production of assessable income in the locality of the time. And in that case, the taxpayer actually lost the case, and they said it is not an inherent risk that your partner will steal money from you. Now, anybody will tell you that if you enter into a partnership with somebody, it's inherent risk that the partner will actually steal money from you. That's just part of life nowadays. So the Lockheed brothers case was the 1922 case. And that case was referred to in the 1960s case of 952. Now read what the judge said. It says, one does not reasonably expect a senior manager or managing director to make away with his employer's funds, and that such a risk is not reasonably incidental to the trade, as the petty larcenies of servants and the leakages through carelessness or dishonesty to which the revenues of most profit-earning organizations are exposed. What absolute nonsense. Isn't it hogwash? If you try to say that a director or a manager is more or less ethical than a junior person that works in your factory or works as a stock clerk or maybe just a plain security guard, where are we going? That's just absolute nonsense. What should have happened in this interpretation note, SARS should have absolutely distanced himself with that derogatory statement made by the judge in ITC 950 is absolute nonsense, because how can you link ethics with the level of position that you have? I know many people that are managing directors that's got much poorer ethics than a person that's actually absolutely destitute, and it's nonsense. So what does SARS say in the interpretation note? A bit of a vague statement. SARS recognizes, this is an extract from the statement, SARS recognizes that times have changed since the Lockheed brothers and ITC 952 cases. Nonsense. People have always been corrupt since the beginning of time. and that embezzlement, fraud, and theft by senior managers has become more prevalent. Okay. Yes, obviously it's become more prevalent, but not more or less. I think it was always. My dad always said, power corrupts and absolute power corrupts absolutely. So it's always been there since the beginning of time. Perhaps now, because we've got data analytics, because we've got more accountability in the world, we pick them up a bit better than we used to pick them up 100 years ago. All right. So what SARS says is a loss arising as a result of embezzlement, fraud, or theft by a senior employee will therefore not automatically be denied as a deduction. Thank goodness. Okay. So they are saying there, however, there may still be circumstances in which the risk of embezzlement, fraud, or theft by a senior manager is not inherent in the particular case. For example, the theft of a company's cash by a director who is also the sole shareholder of the company. What nonsense. How can you steal from a company where you own all the shares? It's just impossible. That is called a dividend. That's what you're doing. Okay. You can't steal from a company that you own all the shares in. It's called a dividend. You have to pay dividend tax. It is not subject to you can't get a tax deduction because it's a dividend. And I just get so concerned when SARS writes these things on a piece of paper because it's just nonsense. Okay. But clearly they must say each case must be considered on its own merits. All right. So that is theft by an employee. Make sure that you recover the money. Then you've got theft by external contractors. And then again, an absolute nonsense of a court case. That is ITC 1661, and that was heard in 1998. So again, the company actually appointed a firm of auditors, and they were a firm of dentists, and they appointed auditors. And they said to the auditors, please do everything for me. And the auditors went there and stole the money of the dentists. And hold of low, the court found that that theft of the auditors were not tax deductible for the poor dentists. And they're saying two reasons. They're saying, one, if you want to claim something, you must incur the expense before you earn the income. What nonsense is that? And then second one, it was not an inherent risk of the taxpayer business. And it's so unfortunate that they didn't take this in appeal, but it's such a nonsense case that even SARS is criticizing the case. Why SARS even took it to the court, I do not believe. So SARS is saying, effectively in this, they're saying, the fact that the income was earned before the loss occurred is no bar to the tax deduction. So they're criticizing their own case. And they're saying it is submitted that this would be incorrect approach to follow, that the correct test, which is in line with the case authorities discussed earlier in this note, is to consider whether on the facts the risk of the loss was an inherent risk in the taxpayer business. And in the interpretation note, SARS actually advised the poor dentist how they should have fought this thing. Well, SARS should never have challenged it. But here they come up with their own nonsense again. So, for example, if an employee or independent contractor, who is also the sole shareholder of the company, perpetrated the theft, the loss is unlikely to be considered an inherent risk of the business. What nonsense. Again, you can't steal from a company with a sole shareholder. It's impossible. Even you call yourself an independent contractor or not. Again, it's just unfortunate because it undermines the whole thing. They should just have come clean. It is a real risk. If you allow an independent contractor on your premises, there's a risk they're going to steal from you. If you allow auditors to do your books, if you allow anybody to do your books, if you allow somebody to do a registered tax practitioner, there is a risk that that person is going to steal your money. I've heard so much time of people put into fiduciary responsibilities over your funds that just goes out and steal the money. All right. Now, in interpretation note 80, and this was as I was doing research for this whole webinar, I came upon this one that is very, very concerning in many cases. Interpretation note 80 deals with a loss of a capital nature, theft of a capital nature. So again, if I were to refer back, unfortunately, to the current looting, if somebody comes in, they break down your doors, they steal your stock. Clearly, that is a loss of a capital revenue. But if they come out and they burn down your building, burning down your building is a loss of a the first one is a revenue nature, you can get a tax deduction. But if they come down and they burn down your building, that is a loss of a capital nature. All right, so depending on what it is, you've either got a capital loss or you've got a revenue loss. The loss of a building that the looters came in and they burned it down, you cannot claim a normal income tax deduction. So you have to look, what is the loss that you've suffered? So what the interpretation it says is if your financial accountant steals money from your current account that you're using to fund the monies, then you can get a tax deduction. But if they go and steal money from a fixed deposit that you had, then it may be a capital loss. So be very careful about that, and take guidance from a tax professional when you are faced with this. But as you can see, you can't just say, well, an employee stole from me. You've also got to look at what did they steal. So you may have a capital loss where you think you have a revenue loss. And with that, also look at the VAT implications and the rollover relief in the Capital Gains Tax Act and the like. All right. So they just elaborate on that. Or just know if somebody steals physical cash from you, they steal bank notes from you. If you are a bank, a retail banker, that physical note is trading stock, and as somebody does a cash in transit heist, then that loss will be a revenue loss. In some instances, if that is capital, you can't claim capital loss. So if you are a private individual and you have 10,000 Rand lying under your bed, and somebody comes and steals that 10,000 Rand, you can't get a capital loss either. It's also not a revenue loss because it's outside the scope of your business. All right, so, and this is really where you now go, you have to incur costs in order to now prove that there has been theft or fraud. You need to have legal expenses. You have to incur costs on, for example, Jacques van Wyck's team to look at it, issue a report, help you through the process. What do you do with that? If it's legal services, that legal services need to meet the requirements of Section 11C. So you look at the claim, and if the claim would be tax deductible, then the legal fees will follow suit. If the claim will not be tax deductible, if it's capital, then you can add it to the capital loss that you're incurring, and so it follows the nature of the suit that you have. All right. Other costs, for example, cost of an accountant or your auditor's cost that you investigated, internal audit expenses, those kind of things, you have to look at each one individually because some of it may be deductible, some of it may not be deductible. All right. Now, SARS says, as with anything, the onus to prove the deductibility of a particular deduction rests on you. So now there has been theft in the organization. How do you prove that? So the interpretation note actually elaborates on that. They say you have to have sufficient information to say, is there a police case docket number? Is there a report from a private investigator? Is there a forensic auditor involved? Is there a charge C? Is there anything like that involved so that you can prove it to be able to claim that? Now, just remember, your theft and your fraud often takes various forms, and sometimes you only pick it up years later. So, for example, stock often happens is there's collusion. And as I said, an employee in the stock department colludes with a supplier and they steal a little bit of money. So in year one, they've stolen maybe 20,000 Rand. Year two, another 50,000 Rand. Year three, 400,000 Rand. And by year five, you pick up, hang on, I've got massive stock losses. And now you start looking at it and you pick up in year five that over time, you've lost 2 million Rand. All right. Now, that losses would have been picked up through your stock system and it would have already been claimed for tax purposes. But effectively, what you have is stock losses that's arisen in each year. As you recover it, obviously, you must pay output VAT on it. And as you recover it, you must pay tax on it. But you've already claimed it. So look at exactly what you had. In one instance, we did a due diligence on a client and what they did, they bought a Ferrari and the accounting entries was credit, bank, and debit input tax. So SARS is the proud owner of a Ferrari. They don't necessarily know that, but out of the due diligence, we actually picked it up and the client never bought the company. But they did sort that out through a VDP process. So be very careful about what you are doing. So SARS also deals with the tax position for the perpetrator. So that's the message to our looters out there. So please look at this interpretation note 80 and do that in your tax return. All right. So a thief will be taxed on stolen monies even if it falls within the thief's, as it falls within the gross income. So it's just a general gross income definition. And the general gross income definition says you must be taxed on any amount that you receive or accrue to you. When you steal money, it can never accrue to you. So there is never any accrual. So the time that you must include it in your taxable income is the time that you receive the money. So, all right. And you can't believe it. There's actually been a bucket load of court cases on this from the perspective of the thief or the perpetrator. All right. So in ITC 1624, what happened is that the taxpayer was an agent, fraudulently overcharged the principal. And at the end of the day, they had to refund the money. So what they did is, let's assume they fraudulently overcharged by $1 million, and then they got caught out and they had to refund the $1 million. So they said, hang on, we don't want to be taxed on $1 million because SARS taxed them on $1 million. And it went to court. And the court said, no. You received it. You intended to use it as part of your own money. You should be taxed on the $1 million. And by the way, when you refund that money, I'm not going to give you a tax deduction because the rules are different. When you receive, you don't have to conduct a trade in order to be taxed on amount of income. If you receive or accrue it, it's taxable unless it's a capital gain. So yes, maybe somebody will say, I've had a fortuitous gain by, this TV just landed in my laptop as I walk past the shop. That's a fortuitous gain. It's capital in nature. It's not going to work. But it's the only way you can get it out of your taxable income, arguing it's capital in nature. In this case, it's clearly taxable income. Now, and the Supreme Court actually found that an illegal contract does have legal consequences. So if you receive money, you intended to use it for your own purposes, you must pay tax on it. So as you go through the Zondo Commission, as you think about all these horrible things that people have done, they might pay tax on it. All right. Now they get caught out. The Zondo Commission is not leaving it there. They're saying, hang on, you've got to refund this money. If Eskom had a contract with a supplier and through some means they did not follow protocols and they didn't follow the tender procedures, and that supplier then have to repay it if it was a corrupt activity through the Prevention of Corrupt Activities Act, can you get the tax deduction as you pay that money back? Okay, so this is what was dealt with in the court. And listen to how the judge in the Lord Denning said. Take a gang of burglars. Are they engaged in a trade or an adventure in the nature of a trade? They have an organization. They spend money on equipment. They acquire goods by their efforts. They sell their goods. They make a profit. What detail is lacking in their adventure? You may say it lacks legality, but it has been held that legality is not an essential characteristic of a trade. You cannot point to any detail that it lacks. And then the judge brought some sanity to it and said, listen, I don't care. But still, it is not a trade, nor an adventure in the nature of a trade. And how does it help to ask the question, if it is not a trade, what it is? It is a burglary, and that is all there is to say about it. So the judge said, listen, yes, we can have these gangsters. Obviously, looking at organized crime, they are more organized than we are. So they have people that have hierarchies, they've got everything in there. They're not conducting a trade, so I'm not going to allow them a tax deduction for any of the expenses that incur because it's pure theft. That's it. And we are saying it's not a trade. Interesting way, and that's why I'm saying courts tend to favor the ethics, fortunately so. All right. So in summary, a person who derives money, whether it's legal, illegal, through embezzlement, fraud, or theft, they must pay tax on it, and they will not be allowed a tax deduction for that.
Johan, thanks a lot. I must say, I like it that judges have a sense of humor, and even there's some humor in tax as well. So I hope you are very busy the next couple of months for legal advice and tax advice for all the looters, but somehow I doubt that. So let's, in your 3 years of experience as a tax advisor, you must have been confronted in many cases by clients who may have sailed somewhat close to the wind insofar as tax planning is concerned. And, a lot of these are professional people as well. What is the responsibility of the professional, irrespective of which governing body and which discipline they belong to, when they are confronted with potential irregularities?
Well, that is so important. And this section of the talk is really about what the public expect from the professional. And in this, irrespective of who your governing body is, whether it is a site or whether it is SICA, whether it's IRBA, whether it's SIPA or SIBA or whoever it is, The reality is we are professions and we are bound by a code of conduct. And when the public thinks that you are a member of SITE, for example, there is an expectation of a particular conduct. And all of these institutions have got codes of conduct that you need to adhere to. And it's important because think now, we are in a medical crisis. We are in a global pandemic. As you go to the doctor because you are sick, you trust that doctor because it's important. What we do as auditors, what we do as professional consultants, what we do as valuators, what we do as tax professionals, it matters. And if we do it wrong, or if we do it in an unethical matter, people suffer damages. Whether it is on a macro basis, that the country as a whole suffer because we are getting to anarchy, tax anarchy, or accounting anarchy, of misrepresentations. And you can just look at all the cases that there is about, think about how much damage there has been caused by the financial misrepresentations by major companies, listed companies in South Africa. It's massive. People, livelihoods gets damaged. So there's an expectation on that. Now, in a tax perspective, I've dealt with that often, where a client will come to you and say, listen, what will happen if I don't? What will happen if I claim this as a tax deduction? What will happen if I do not disclose that amount as a taxable income? My first answer to them is that there is a difference between a tax uncertain position and a tax illegal position. If you can argue both ways, it's a tax uncertain position. It's something that, and you can protect yourself with that by getting an opinion and looking at a different way, but at least you've got an argument in the whole matter. A tax illegal position, if clearly you are contravening the law. So when somebody comes to me with a tax illegal position, I say to them, listen, firstly, I will never be party to that. And I will most probably sever my ties with you if you insist on doing that. All right. So you can't mix yourself with that because you are at risk as a professional, and we're placing the entire profession at dispute, the entire professional. It's just as much as a doctor gives you the wrong advice because he just wants to be after money. And an oncologist telling you to go, telling somebody that's 90 years old to go through very invasive surgery and everything, and it's not the right advice. People looking at us because they trust us. Okay, and we need to be trustworthy. All right, so the first thing is, it's a very sad day when we have to legislate professionalism, but unfortunately we do have to. So let's look at what legislation has been in there, and I'm only going to focus on two areas, and that is on your CASAs as well as your registered auditors. But everyone has got the same, and you need to familiarize yourself with the rules. Okay, so what are the no-claw rules and the CASA? No-claw is for non-compliance with laws and regulations. And what has happened is, a number of years ago, is the Code of Professional Conduct for Chartered Accountants was amended. Part of your professional conduct is that you need to maintain confidentiality. These rules were changed so that you can breach confidentiality if there are certain elements that's happening. And I actually think it's not a bad piece of legislation. Now, just quickly going to address it. It deals with the CA who's got clients, who's in public practice. It deals with the CA that is who's got clients. So I, as a chartered accountant, I go to a client and the client says to me, and you pick something up, and you see that they have contravened a law. Now, that law could be something that will have a material or financial impact, or it can be something that can damage the benefit of the public at large. So I can even go to a client and I can see somebody is washing, I'm on the 10th floor, and somebody's washing the windows without a security harness. Even that can be a no-claw. Okay. It can also affect me if I'm an employee. So if I'm an employee and I see that my employer is doing something untoward, I am a junior financial accountant, and something doesn't look out, and I see, hang on, money going out here. It's all going to the Bahamas or Guernsey, and they are contravening clearly the Reserve Bank exchange controls, and it's going to somebody's account. As a CA, you've got certain obligations because you are bound by code of conduct. All right. Now, fortunately, under this rules, what you do is you report this thing to the people responsible for the governance of that organization. So that's the first step. So you report it to them and you say to them, whether you're an employee or whether you're an external, it applies to both. And you give them chance to rectify. From a tax perspective, it's very easy. Go to clients and say, listen, you buggered this thing up. You need to rectify through a VDP. Now, fortunately, the vast majority of clients, all of the clients that we have at Kreston, they want to comply with the laws. And many instances, we'll pick something up and it will be an absolute surprise for them. And it just stops there. We fix it with a VDP, we fix it and on we go. Okay. If it's more difficult, if you're an employee and you now go into confrontational relationship with your employer, where you say, listen, I'm seeing that you're doing, but remember what's at stake. You've worked very hard for your degree. It's at stake because that can be taken away. So if SICA picks this up, that you have not reported, you've not followed the no law, they can take away your qualifications, they can institute punitive actions, they can put a fine onto you. All right. So what do you do if the client or your employer then fix it? Problem solved. No problem. You don't report it to anybody, you don't report it to SARS. It is less certain what you do if your client does nothing. They are specific there. They say the mere fact that you then resign as an employee or the mere fact that you will then withdraw from the engagement from that is not sufficient. But because you have to decide, you have to apply a professional judgment, then what you have to do. If it's tax fraud, arguably you have to go and report it to SARS. You can, okay? You're perhaps obligated to do that. But unfortunately, the guide is not clear on exactly what you have to do. As an employee, if you report it through the ethics hotline, perhaps that one would be fine. And at least you protected yourself by reporting to the ethics hotline. But you can follow up because the ethics hotline need to come back to you and say what you've done on that. All right. So unfortunately, but also fortunately, because I think for all of us, it is important for us to be a professional. And without making sure that the profession, it's not our jobs to collude with our clients to help them to commit fraud. And you started doing that with tongue in the cheek. But 20 years ago, that happened. And we should make sure that it doesn't happen because it affects the reputation of our profession. All right. The next one is the IRBA requirements. And that one preceded the requirements of no-CLAR. Oh, just one thing. Under no-CLAR, it only applies to me for my employer or for my client. If, for example, somebody will ask me to do a due diligence and the target company, I see that they are committing fraud, I don't have a no-CLAR responsibility because they're not a client, okay? If my client then buys that company, I would have immediately a no-CLAR responsibility because they need to fix it. So it only applies to a client. That the DD target is not my client. My client is the client who's saying to me, do the DD on this. So let's look at this for the poor registered auditor. Now, in the registered auditor, that is the RI legislation, reportable irregularities and the registered auditor. So in that one, if the auditor, and in both instances, you don't need to have evidence that is actually fraud. You just have to have reason to believe that it's a problem. You have to so what I've seen many instances now, as the Zondo Commission is coming up with things, the auditors are they are just issuing RIs. They are saying, listen, out of the Zondo Commission, we have reason to believe that you've made an undue payment to that company, and that is non-deductible in terms of Section 22. It's a contravention of the Prevention of Fraud and Corruption Act, and you'll go along with that. So the auditor has reason to believe what they must do, and this is the difference from no-CLAR. No-CLAR, you go to the client, people responsible for corporate governance, tell them fix it. Okay? If they don't fix it, you take further action. This one, you don't go first to the client. You draw up all your paperwork and you send it to IRBA. Okay. Only after you've sent it to IRBA, and in most instances it's done simultaneously, then you say, I've sent this document to IRBA. Here's what I sent to IRBA. Then the client has got time to respond to that, have their own case, and that response also gets sent to IRBA. And then you have to do a follow-up. And that follow-up report would be either you have now dealt with it appropriately, or it is still a remaining issue. What happens on IRBA? IRBA, and not you, then have the responsibility to then take it to the regulator, which if it's a tax fraud, take it to the tax authorities. If it's a commercial fraud, take it to the Hawks, the police services, whoever. Now, if you don't do that, then that registered auditor can be sanctioned, penalties. They can lose their ability to sign off audits is their very well-being. It is, and there are two sides of it. The auditor should take this very, very seriously because it entrenches the importance to be independent. It's so important. The clients, unfortunately, the consequence of that was that clients are not that open with their auditors anymore. Because when the client, this is not, if the client just tells you about it, then you may have an RI responsibility. So often we find that the split between audit services and non-audit services, the client will go to the non-audit and say, listen, can you just help me? I may have a no-CLAR one, but that's fine because I'm helping to do a VDP and sort it out. Then we go to the auditors. We said we've sorted it all out. Be it as it may, now this is just the IRBA and it is the SICA rules. But as I said, site will have its own rules. SIPA, SIBA, all of the organizations will have their own rules. Be careful, before you know it, you can be in trouble. And remember also, SARS can go after the tax advisor. And SARS can lay a complaint if you are negligent or do not take due care when you do any tax return. SARS will lay a complaint with your regulatory authority. They will cancel your registration with that authority, and you lose your ability to practice as a registered tax practitioner. So, in a nutshell.
Thanks a lot, Johan. I see we've got a few minutes left. You touched on mergers and acquisitions and due diligences, etc. The risk of undisclosed liabilities arising from the various types of fraud, theft, and corrupt activities is significant whenever a business acquisition is considered. How should the prospective buyer protect him against the risk with specific reference to the due diligence process that you are conducting, and also contractual protection for the client?
Yeah, Jacques, that is so important, and we're seeing actually a lot of activity now in the mergers, acquisitions, reorganizations, and new shares and everything. And there's no reason to let the buyer beware. So the buyer needs to protect themselves in a variety of manners. The first instance is do a proper due diligence. Don't skimp on it. Don't just ask for a high-level one. Do a proper one where you do a legal due diligence, a financial due diligence, you do a tax due diligence, and you get some assurance that there are no significant matters that came to your attention. The mere fact that the auditors didn't pick it up it doesn't give you assurance. Remember, the auditor give you assurance that the financial statements seen as a whole reasonable represents the auditor doesn't give you a guarantee that there has been no fraud. So the first thing is to do a proper due diligence conducted by people that actually know what they're doing. Include in that a proper tax due diligence, because you need, and it's not just a compliance due diligence. I often see that tax due diligence, the scope of the tax due diligence is, have you submitted all your returns? Yes. Are there any queries with SARS? No. That doesn't mean you don't have gremlins. You need to do a proper diagnostic and see where are the issues that's lying there. So that's on one side, you can protect yourself. And I've done numerous due diligences. We actually go to the target company, say to them, don't buy those shares. There are too many gremlins in there. Buy the business out of the shares, that's fine. Buy the assets out. You can carry on. You're not taking over the history of their nonsense that they have carried on. And often what happens, as companies grow, they unfortunately don't grow their controls with it. And as they become big enough, now they're facing a 50, 100 million rand deal, and the buyer is saying, listen, I'm not buying these shares because simply you've taken shortcuts, okay? So it's a preemptive approach in that. So the first thing is do a proper due diligence. The second thing is protect yourself from a legal perspective. In that regard, have sufficient tax guarantees. If you pay a certain amount, make sure that a certain component is kept in escrow to make sure that if there's any gremlins coming out as you are taking control of the company, that you can just take the money out of the escrow and deal with that on that manner. So it's best practice to have a part of the proceeds kept in escrow for the benefit of the purchaser. Just if there's any amendments, if there's undisclosed liabilities, or everything like that, because most of those things come out in the wash afterwards. I've had a client where huge SEC listed client, they bought a local company, and then the previous director and his wife separated, and the wife said, hang on, do you know what they did? They did expansions in the factory, but part of that money they actually built a house for us with that money, but it all went through the company. So it went through the whistleblowers thing at SARS. My company bought it, but they ended up with that tax liability because it ended up that they claimed the tax deduction, it was employment related, it was all that nonsense. They had nothing to do with it, but we had to deal with it. All right. And obviously they can try and recover it from the director, but he was long gone. So contractually try to put a little bit of money away for it, and then obviously put some kind of security in there. So those are the main issues: property diligence, legal protection, as well as financial protection, and maybe a little bit of money in the escrow account.
Okay. Johan, I see we've run out of time. You know, in one of these sessions, I think we have to discuss tax avoidance and reportable arrangements as well, because that's heavily weighing on practitioners as well. But I think thanks a lot for your input, Phillip, Kaliati, and Jacques van Wyk. Thanks a lot for your input as well. I trust that this webinar has been insightful for you. It's definitely been for me. You have the information there of the contact of the different Kreston offices. Please feel free to contact us if you need advice or tax advice and advice regarding fraud, you know, how to combat that and put in specific policies and procedures. We can definitely assist you, and if we can't assist you, we'll get someone to assist you. So please contact us. It's been a privilege to host this webinar, and thanks a lot for your contribution. Hopefully we can answer your questions that you've posted, and if not, please email us and we can assist you through that. Thanks a lot to all the presenters as well, and thanks. Have a good day.